Thanks for tuning in with me here on the Retirement Income Source. I'm Tim Sparks, where it's always about increasing your income. In other words, income methods the old-fashioned way. In the 70s and the early 80s, income was very common amongst investors that were going into retirement. As a matter of fact, it was kind of somewhat easy. But it kind of got pushed to the wayside, and most people started focusing on growth because guess what was coming? We had a really great growth pattern in the market, and so the mid '80s till late 1999, the market was just it did more growth than ever as far as looking back historically in the S&P 500. So our show is sponsored by Sparks Financial Group, and we're a firm right here in Lexington, Kentucky. And this show is for you, the listener, whether you're a pre-retiree that's planning on retiring soon or a retiree that wants their retirement to end well. And what do I mean by end well? Well, none of us want to run out of money before we run out of breath. And so the goal is to be diligent. When I say be diligent, I'm talking about take time to be able to learn and understand how income works in your portfolio. Most people that even when they call in from the radio show and for the retirement risk review and so forth, what I find is they somewhat understand what I'm talking about investing for income, but it does not totally connect. And the biggest reason why is because we're creatures of habit. We're still remembering what built our wealth. In other words, how we accumulate wealth. And so we're so much in that mode, and that's all we've understood. We feel like that whenever we make a change, of course, none of us like to really change, right? Because change is, why change if everything is doing well? But whenever you go into retirement, if you want to be equally successful in retirement, just like it was when you were successful in accumulating wealth, then it's so extremely important to be able to make that shift, especially if you don't want to run out of money before you run out of breath. And so today we're going to be talking about risk and income. You see, there's a lot of risk out there, right? I would say the risk the two things that people are concerned about is market volatility. That's where they can lose money, and also inflation. That's the two things we hear about the most right now. Well, in the last 3 years, believe it or not, inflation has won the ball game. Even stocks have not surpassed inflation, unless you owned maybe some of the high flyers like Nvidia or Apple or maybe Amazon and some of those companies. But in general speaking, because most people are diversified, so that's none of us, or we all know that we don't want to put too much risk in one company, although those companies have done very well. But if you owned even Nvidia several years ago, it really did not really do a lot like it did in the last couple years. And I don't want to really talk about a company that's done very well and has formulated a chip that is by far light years ahead of the competition. But I do know, as far as how companies work, and there's other competition out there even to this company. It's a bloody ocean. Technology is a bloody ocean. What that means is there somebody else out there already trying to one up on what they've already accomplished? So, enjoy it while it lasts. It may last quite a long time, but I do know, just based on experience in any industry, there's a time when you get to enjoy things, and there's a time that you start seeing, that it was maybe a time to sell and go a different direction. Now, that's not giving you advice. That's just basically giving you my 2 cents worth. I'm like anybody else. I'm just giving you my opinion, and we all have them, right? They're just like armpits. And, eventually we start stinking, right? And so that's the same way I feel like when it comes to these high flyers. And there's other investment options out there. I mean, we have people all the time worried about, the currency and, digital currency that don't even exist yet. And I'm not talking about crypto. Crypto does exist. We already know that by Bitcoin and Ethereum and a couple of these other cryptocurrencies. But people all the time calling me and asking me, well, what do you think? And I don't really get into that world. That's more speculative to me. And my personal opinion of crypto and all this digital currency, which doesn't as of yet exist, is even if it did come out and America came out with their own digital currency, then you're going to be able to shift all what is currently under the US dollar, and it's going to eventually convert over to digital currency. So you're going to have that time to be able to do that and not get caught up into the noise. And I'm just not a big fan of that. Now, it's up to you. If you like listening to that stuff, I choose not. I don't want my mind cluttered with things that don't even exist. But getting back to the main topic about risk tolerance and income. As a matter of fact, most importantly, risk, there's a lot of risk, and people sometimes can't associate the difference between the two, although we understand what risk means. When it comes to our money, that's where the rubber meets the road. In other words, we want to be able to make sure that we're taking the appropriate risk that allows us to have staying power while we are in the market and trying to get income simultaneously. So I got a commission report I want to get in your hand that is going to be fitting for today's show. And this will be part of a package for the people that call in, along with a particular book that we will also add to that for your further education. But this commission report is called Risk Tolerance and Investing for Income. Very similar to the name of the show. And I think that will really help you to be able to understand the level of risk and all the other nuances that you're going to be taking on and challenges when you go into retirement. And you can have this report by calling 888-930-1080. Again, that's 888-930-1080. We'll mail this to your email at whichever you prefer. Again, that's 888-930-1080. You're tuned in to the Retirement Income Source. I'm Tim Sparks, and we're talking about risk and income. When you go into retirement, or you're still 5 years away, for example, it could be 3 years away, or it could be 8 years away, then you want to become more eye-focused and not continue the path that you're on right now, which is called total return. Although total return may work, but it depends on what direction the markets go, where if you're eye-focused, you can still hit your target. Because first of all, we all need income when we reach our retirement. And we need it because we have needed goals. In other words, we have expenses that we need income for to be able to pay for those. And also, most importantly, the one that gets neglected a lot in planning is the fun goals, the things that we're going to do, because we got a lot of time now on our hands and we're going to utilize it somewhere. And I can share with you that I very seldom have ever met somebody that went into retirement that just basically stayed home and ate popcorn and drunk Kool-Aid every day. So again, eye focus allows you to take income confidently without the concerns of values changing either less or more. I mean, think about it for a moment. That's no different from a landlord that owns a rental property. If the landlord is collecting rent of, let's just say, $1,000 a month, which is $12,000 a year, yes, there's expenses that comes along with that, property taxes and insurance, but let's just stick with the method here. There's $12,000 a year coming in. Well, the property is worth, let's just say, $200,000. Well, they're leveraging an asset that has potential for growth, and that's the real estate. And then they're collecting income in the form of rent. Well, if that real estate value, if they was to do appraisal on it the following year, the $200,000 house is now worth $250,000. Well, the $50,000 that was realized is not considered income unless you do what? You have to sell to get it. Well, what's income is the $12,000 that's coming in. But as far as looking at a asset worksheet, the particular investor made $50,000 of money, plus they made an additional $12,000 in rent. Well, that's what I'm talking about when it comes to owning stocks. You see, the value of those stocks is consistent of shares. You own shares, whether it's consists of $1 million, or you own shares and it totals up to $500,000, or if it's $3 million, it doesn't really matter. You're collecting rent called dividends. And when you go into retirement, since income is the goal that you're trying to reach, it makes perfect sense to invest for stocks that actually pay incomes, like the landlord that collects rent. Why? Because you've got to be able to have income. Plus, you want to be able to stay in the market and have some wins. Well, when it comes to dividend-paying stocks, and in general, and this is for people that are probably 5 years out from retirement, and they don't want to maybe miss out on maybe some potential growth, which is sometimes the reason why people wait and don't go into more of an income type of portfolio yet, because they're afraid that, well, hey, what if I make another, on this $1 million, make another $500,000 on my money in 5 years? And it makes perfect sense. But if you're in a income portfolio first that's in stocks, you can potentially attain somewhere in the same kind of return. And so just like the piece of real estate with the landlord went from $200,000 to $250,000. But keep in mind, when it comes to retirement, you don't have to necessarily always focus on the balance. The key is how much income you're getting from the balance that you currently have. And so that's what I mean. When you invest in stocks, you're going to have fluctuation, just like the landlord's going to see fluctuation if they did appraisals consistently on their real estate. No difference. As long as the rent's coming in, as long as the dividends are coming in, they can be able. It allows them to have staying power while they're in the market. And most importantly, be able to achieve the other goal, just in case the markets go up, they can see their stocks go up in value as well. And especially if you really know what you're doing, because dividend-paying stocks, some of them don't have any value increases and others do, but it takes really a specialist to be able to define those companies and actually can do both, kill two birds with one stone. And speaking of that, I like to get a book in your hand called The Return on Principle. And it's authored by CFA Dave Scranton. And I got a free copy for the first 5 callers of today's retirement income source by calling 888-930-1080. Again, that's 888-930-1080. We will mail that to you if you are one of the first 5 callers. Free, no obligation book. My number again is 888-930-1080. You're tuned in to the Retirement Income Source with Tim Sparks. We'll be right back for some more great information when it comes to risk and income. Welcome to the Retirement Income Source. This is Tim Sparks, and our show is sponsored by Sparks Financial Group, right here in the heart of the Bluegrass, Lexington, Kentucky. This show is always going to be about the importance of income investing. Thank you for listening today, as we're going to be talking about risk and income. That's a mouthful, right? I mean, think about it for a moment. This year and probably last year when the market started coming back, probably even though people were taking risks, they just went ahead and took income from their portfolios. And so far, everything's been working out pretty good, right? When the markets are positive, we feel good about spending our money. Well, did you know that even the year before in 2022, when the market had actually descended about 25% on average, including bonds and everything included, our clients' income didn't change one bit. The income that they had prior to, like in 2021, when the markets were going up and then it descended back down 25+% the following year, doesn't mean the income changes. no different from a landlord, like earlier in our first segment, I was talking about where a landlord has a piece of real estate that has a potential going up in value, and let's just say it's worth $200,000, and they're collecting $1,000 a month in rent, or $12,000 a year. Well, that rent doesn't change if that $200,000 house went down in value after an appraisal was assessed on it a year later. Now, let's just say it went down to $170,000. So you see, rent does not change. Neither does the amount of shares that you bought from a particular company that consists of, let's just say, $200,000, and you had dividends coming in. Then the value of those share prices went down, but the income did not change. Matter of fact, there is several dividend paying companies out there, at least half of them, that have a gradual increase in dividends as well. And so a lot of people don't really realize that. There are some companies out there that when you do some research that can generate up to 3 or 4 or 5% on average increase, and have historically done that for quite a long time. And so, and Pepsi-Cola, for example, is one of those companies. 6.9% increase each and every year. Other companies are different. Now, I'm not making a suggestion, go out there and buy a Pepsi-Cola. I'm just trying to make a comment about what I mean by dividend-paying companies, and especially when it comes to dividends increasing. Imagine getting an increase in income even though the markets are down. Well, most people think that when the value of their portfolio goes down, so does the income. Well, that couldn't be no more further from the truth, because if you invest correctly and you're investing for income, that's the whole point of this show, is to help people to understand that that if you invest for income in a particular investments like stocks and bonds and bond-like instruments, then that income doesn't change, even though the balances can fluctuate. You know, and of course, the name of the show is Risk and Income. Just as long as the risk is appropriate for you, and you can do that and customize that risk that's appropriate for you, that allows you to stay in the market and continue to get that income, even though it kind of feels uncomfortable getting income when the assets are basically being suppressed. The value can go down just like it can on a piece of real estate. No different between the two analogies. To be quite honest with you, if I'm a person going in retirement, that's the only way I would feel confident investing my money in the stock market, is being able to have dividends, having something coming in very consistently each and every month. And when you invest for renewable resources like bonds and bond-like instruments, you will do that, because those are the tools that are appropriate for people that need income in retirement. And the people that don't get that do not get that kind of income, that are not set up for renewable resources like bonds and bond-like instruments, for example, they're basically engineering their income, or their advisor is on their behalf, and calling it income by withdrawing their principal. They're selling their shares. So just like going back by a minute ago in 2022, when the market took a 25%. Now keep in mind, the people that are listening to this show, when the markets go down, and keep in mind, we know they're going to go down again. They're going to go down in the next 30 years. This show is not I'm not being a Debbie Downer, but when the markets go down, you have to be prepared for that, because you still need income. And question is how are you going to get it? So you can't say that, okay, I'm going to go ahead and sell principal and it goes down 25%. That means I'm going to be taking a 25% cut on the price, which means I'm going to sell more shares to come up with the same income. That is not the way people, that's not a great income plan. And not only that, that's the biggest reason why that people are worried that they're going to run out of money before they run out of breath. But speaking of that, there's a great commission report I like getting your hand. Great, interesting read. Takes less than 10 minutes to read, called Passive Income for Retirement. In other words, when you transition into retirement, you want to have passive income coming in. Rental properties are a great example. Stocks and bond-like instruments. A great read to be able to get your mindset. If you're going to be focusing on income, then by all means, you need to know what tools actually do that. And this commission report can be yours if you call 888-930-1080. Again, that's 888-930-1080. We will mail this to you or even email it, whichever you prefer. Again, that number is 888-930-1080. You're tuned in to the Retirement Income Source. Thanks for listening. I'm Tim Sparks, and we're talking about risk and income. You see, when you go into retirement, or you're still maybe 5 years away and you want to prepare for retirement, then by all means, make a shift. Be more I-focused. I-focus basically means you're going to go ahead and invest for income now. And if you invest for income now, there's a profound effect by the time you reach, let's just say you're 5 years out, you're 60 and you're going to be 65, and you start focusing on focus for income first. Well, what happens if, and let's just say you don't want to give up the potential growth. Well, you can hit your target, by the way, in 5 years, and here's the reason why. I'm going to give you a great example. I'm sitting here looking at a particular client that's all stocks, that's been with us now going on 4+ years, and their income started off, their balance started off, let's see here, it was right around $500,000. This is just part of their money. They wanted all stocks in this portfolio, and their particular income was $25,000 a year. In other words, they're focusing on dividends. And then you get to the following year, their income jumped up to $29,000. Their balance also moved up several $100,000 because we had some exponential growth following the pandemic. And then the balance jumped up another it looks like $30,000 or $40,000. Now it's up to $800,000 with a $30,000 income. And now currently their income is at $34,000 a year with a balance of $860,000. So they started off with $500,000. They're up $300,000 more. That means they had growth. They had more consistent growth because this is the top portfolio custom for them. And at the same time, their income went up 4 simultaneous years. So in other words, you're getting income each and every year. So you're going to hit your goal if you do that. How is that? Because dividends reinvest themselves. And when they reinvest themselves, they buy more shares. And so organically, your portfolio is going to grow naturally over time. I'm not saying you can't add growth to your portfolio, but this particular person wanted income and income first. And once they understood just exactly kind of what I went through here, how their income continues to compound on itself year after year. And by the way, people, if the market goes down, it compounds even more so. It jumps up even higher. Why? Because the more shares you buy, the more the income goes up. And so that's the reason why people, they take us up on the retirement income report, because it allows them to be able to see how that works and see it factually versus somebody talking hypothetically. And so, we have a commission report where we talk about investing for income in stocks. You see, you can invest in stocks in a growth way, or you can invest in stocks in an income way. Well, when you're starting to segue into retirement, it makes perfect sense to start focusing more on income and start minimizing your exposure to growth stocks. Yes, there's great years in growth like we've seen in the last 17, 18 months. But if over time, consistently, a really good dividend strategy will always keep up neck to neck with growth, and there's many years it's been a proven fact that actually typically dividend value stocks outperform growth over any 5 or 10 year period. And I read a great book on that right there with a particular firm that actually has been doing this for 60 years that actually goes back, not hypothetically speaking, and has actually proved that. But I don't want to get into all of that. That's not the point of this. The point of this is people want income and growth because we're trying to kill 2 birds with 1 stone. One risk is you're afraid you're going to miss out. Another risk is you've got to keep up with inflation, while at the same time you're going to spend income. Well, if you're going to beat inflation and be able to have a chance to be able to have the opportunity of growth, you got to be in stocks. And if you're going to beat inflation, and you're going to have to be invested in growth and potential, but at the same time, you can't sell shares and be able to do that. So I hope you follow me there for a moment. You got to have income and growth simultaneously to beat inflation. There's an excellent book out there called Return on Principle, because what you have is what you got now. That is your current principle. When you segue into retirement, now it's time to put that money to work, even if you're 5 years away and you want to still stay in the stock market. It's a great read, and I'd like to get this in your hand if you're one of the first 5 callers. 888-930-1080. Again, that's 888-930-1080. We'll mail this out to you if you're one of the first 5 callers. Free, no obligation book. 888-930-1080. You are listening to the Retirement Income Source. This is Tim Sparks. We'll be back for some more great information when it comes to risk and income. You're dialed in to the Retirement Income Source. This is Tim Sparks, and I'm your host. And our show is sponsored by Sparks Financial Group right here in the heart of Bluegrass, Lexington, Kentucky. This show is always going to be about the importance of income. Why? Because I've never heard anybody tell me that they don't need it when they go into retirement. Everybody needs income. The question is how are you going to get your income? Is it going to come from principal, or is it going to come from income only? Well, most people want to preserve the principal. In order to do that, you got to find strategies out there that can actually generate income on behalf of your money. Therefore, you are actually preserving your wealth. Why is it so important to preserve your wealth? Well, it's the latter years, the last 5 to 10 years of life. That's your slow and no-go years. You may wind up in the nursing home, or you may wind up needing home health care. If you spent all your resources because you were trying to enjoy your money in the go-go years, you had very little left, and you didn't insure yourself by having long-term care insurance or some kind of a policy like that that could do that, then you run the risk of being able to have to go into a nursing home, and the state will provide you with the room, and a lot of times that can be shared with another person and so forth, and people don't want that. So it's a great way, a great thing you want to do is be able to preserve your capital for those reasons. Yeah, I get it. Sometimes people are not big fans of leaving a lot of money behind, but you got to think of it like this right here. Not just you're battling long-term care, maybe in the future, nursing home expenses or needing home health care, which is extremely expensive today, but you also got to consider inflation. And so the more capital you have in your earlier years, going into your latter years, the more you can, it's not the end of the world if you have to start spending some principal. Because think about the phase, if you got a 30-year retirement plan, you still have your principal 15 to 20 years down the road. It's not the end of the world to start spending income or start spending your principal. Why? Because you were income focused originally. But if you're not income focused, and most people are not, that are listening to this radio, you're actually withdrawing your principal and hoping you're going to be able to grow it back. The problem is it's not just principal, but you're reducing your shares. And when you reduce your shares, you're also reducing your future income. So in other words, it just continually is to compound the effect, and to the point where it becomes permanently, you're permanently cannibalizing your principal. I had a client review the other day with somebody who's been with us now going over a year and a half, and it's a pretty good sized portfolio. It's a little over $2 million, and they're invested for income. They wanted to invest for income before they stepped into retirement. Now, of course, the markets went up, but they were more focused on making sure their income was right, more so than worried about where their balance was going to be before they started into retirement. So we convinced them that it made more sense to invest now, not wait till later, because two things happen, right? And when you go forward, the markets can go up and they can go down. Well, that since there's a 50-50 shot either way, heads you win, tails you lose, this particular client decided to go ahead and focus for income now, even though they was not retired. And since they started taking income, and this couple is, what's his is his, and what's hers is hers. And the biggest reason why is because he lost his spouse several years ago to cancer. He wants to make sure that his children gets the lion's share of the money, but at the same time, he still wants to take care of his new wife. And so these are discussions we have sometimes with people, especially when they're split marriages and the assets are going to go according to the children that they had and not necessarily to each other, like if they were only had one marriage. But that's the way it is sometimes, and I'm starting to see that a little bit more often than not. So that's where Social Security planning comes into play, and so with this couple, they're not taking Social Security. They're just basically living off the income because they saved enough money to be able to sustain their lifestyle without having to take Social Security. But Social Security is a big decision because Social Security, even though there's a split, the assets are going to be split. The Social Security decision needed to be more of, since this husband was the primary wage earner between the two, she's going to wind up inheriting the bigger of the two, which would be more likely his. So since that income is going to go to the new spouse, it makes more sense to be able to delay for him since the income goals are easily met with her assets, and they even got a couple rental properties. So again, it's, everybody's different when it comes to Social Security, but in this case, it allows people to be able to have their cake and eat it too. And so, we suggested they need to take Social Security at age 66 or 67, which, by the way, people, this particular couple were going to take it at age 62. Investing for income allow them to delay. Matter of fact, we're doing educational workshops but both at Sullivan University and Frederick High School here in Lexington, and just in the past 30 days, and I got another one coming up Tuesday at Sullivan, and we got another a set of them coming up in, let's see here, I think it is toward the end of July. And so the point of Social Security is be able to make sure you get it right. Social Security is an extremely important decision. And what we have found is the income message really helps people to be able to have their cake and eat it too. And that way they can get more income even from the Social Security. And this couple got to take advantage of that. So again, because think about it for a moment, inflation is real. It jumped up 20-something%. So imagine investing your money and you're getting more income than you need. Well, that's a good problem to have. I'd rather have too much income than not enough when I go into retirement. And if I'm trying to tackle inflation, income is the key. I got to have more income than my expenses are, and even the fund goes that I want to the joy when I'm in retirement. So if this makes sense to you, I want to get a commission report in your hand that has something to do with a report we actually give people by having a meeting with me, first on the phone and then in the office. It's called the Retirement Risk Report. And it talks about how to make your millions last. And the goal is to get the most income first. I focus first. And just like if you want to maximize Social Security, there's a lot of things encompasses in this report that will be able to help you to come up with the right solution just for you. It's customized for you, which is going to be different from maybe your friends or your colleagues that maybe utilizes other financial services. So if you want to get this commission report, call 888-930-1080. Again, that's 888-930-1080, and we'll mail it to you or email it, whichever you prefer. Again, this report encompasses simply, it's about probably a 10-minute read, but it talks about all the things you need to be thinking about, the risk that associate with income when you go into retirement, and how are you positioned now. 888-930-1080. You're tuned in to the Retirement Income Source. This is Tim Sparks, and today we're talking about risk and income. So speaking of retirement income report, retirement risk report, risk and income, it's related to this show today, is a lot of times people don't really understand. They know how to define risk. You can probably just look up in the dictionary and find out what risk is. But when it comes to going into retirement, what we have found is some people are naturally wired to take risk, and they're fine with taking risk, while others want to avoid risk. So in other words, you're either one of those categories or you're completely in the other. And so when you're in retirement, or going into retirement, you need to make sure you structure your portfolio in a way to be able to meet either or of those types of risk tolerances. And the older we get, it doesn't matter who I've ever met with, even the one that can tolerate risk, a lot of times starts reducing it. So the retirement risk report actually helps you to be able to determine that. And it's based on the asset classes that you're invested in. So once you understand that income first methods makes more sense for retirement, you'll be able to discover whether your income from your own portfolio is either contractual or even non-contractual. And there's a distinction between the two. Matter of fact, the majority of the people we meet with that reduce the risk, they utilize bond funds, or that's suggested to them from their current advisor. Unfortunately, bond funds are not contractual. Contractual basically means, first of all, you could be getting more income investing for the same asset class, like bonds, versus the bond funds, which has lesser income. So in other words, the first thing you want to find out between the two is you're going to get a higher income. Well, a lot of advisors don't want to work with individual bonds because that requires a certain specialist in order to be able to do that. In addition to that, it guarantees your principal back in the future, plus the income is also guaranteed. Those guarantees are contractual, but you're investing currently in bond funds or bond ETFs, which are non-contractual. They have neither one of these guarantees. Of course, this is assuming there's no default risk on that bond. Well, believe it or not, there's default risk in anything, right? Especially when it comes to bond funds. You may just not see it because there could be a bond defaulting inside that bond fund, and it just affects the value of that fund just slightly because you're invested in a lot of bonds inside that fund. But unfortunately, you don't get any guarantees. So that's the reason why we have bond specialists. Somebody that focuses on bonds and bonds alone. And we definitely recommend that for our clients. Another thing this report does is it talks about the fees you're paying, both direct and indirect. The most important one is the indirect. Many people out there like this report, at least that's what they tell us, because they're benefiting. What they're doing from this report is they're benefiting and understanding how much fees they're actually paying. And as we've always said, fees are always an issue in the absence of value. So the direct and indirect means you've got probably mutual funds or ETFs in your portfolio, and you need to know the cost of everything associated with your fund. So in other words, you could be, or the advisor recommending everything could be double dipping. Is there anything wrong with that? No. If you're fine with where you're at, continue that. But you could be you may find out that you're paying more than what you're getting in return. Also, are you protected from future tax increases? There's 3 different taxable type of investing. One of them's taxable, the other one's tax deferred, and the third one's tax free. Tax free, that's Roth IRAs. Tax deferred, that's IRAs and 401ks, certain annuities. Taxable is CDs, or money that you have in a brokerage account, like stocks that pay dividends and so forth. Those are taxable. Why? And the best way of knowing that is you get a 1099 at the end of every year, and you have to report that on your tax return. So again, most people want to be able to know how they can be able to maybe have a little bit more tax deferred than taxable, especially if you're trying to maybe reduce your taxes on your Social Security, and others want to have more tax free but does it make sense to go tax-free? And that is caused by a Roth conversion. So there's a lot of questions that needs, that could be answered there, all just because of this particular report. And most importantly, are you living a lifestyle you want right now? Are you basically leaving money on the table? Quite frankly, most people are. Everybody we come across, and I'm just basically telling you this based on experience, they're not investing for income, they're investing for growth first, income second, which basically means that they're selling principal. Once they understand how much principal they're selling, then they get to that makes them feel uneasy and start realizing, well, maybe I need to be more income first, especially since I need income. What a novel idea. So again, I'm explaining to you what this report does, but this report is a big eye opener. And think about it. We want to be successful in retirement just like it was when we were successful in building our portfolio. In order to do that, you got to be able to make a shift. And keep in mind, if you got income coming in at a much higher level, and it means you're not having to spend principal, and if you're not spending principal, it means you're going to preserve your wealth, and your money is going to go a lot further. So speaking of that, I got an excellent book I'm going to recommend called The Return of Principal. It's authored by CFA Dave Scranton. We talk about investing for income while being in the market at the same time. Why am I the advisor isn't and won't make this kind of recommendation? It answers that question in Chapter 7. This book is so easy to read. We have a lot of people says they read it in 3 hours. Some people it takes 5 to 7 hours. Sometimes they'll go back and reread it again. But it's very important to be able to get educated and informed before you dive into retirement. What you don't know may hurt. So it's always nice to know what total return equals I plus G is all about. And if you're one of the first 5 callers of today's retirement income source, you can get this book by calling 888-930-1080. Again, that's 888-930-1080. And we'll mail it out to you if you're one of the first 5 callers. Free, no obligation book, 888-930-1080. You're tuned in to the Retirement Income Source with Tim Sparks. We'll be back for the last part of today's show, Risk and Income. Welcome to the Retirement Income Source. This is Tim Sparks, your host, sponsored by Sparks Financial Group, right here in the heart of the Bluegrass, Lexington, Kentucky. This show is always going to be about the importance of income. Getting income the old-fashioned way. Today we're talking about risk and income. That's a mouthful. There's so much risk associated with retirement, and we all know that. We probably read up on the information. Maybe we go to YouTubes and listen to certain YouTubes, and we try to get informed and educated. Well, one thing that is not on YouTube's out there, or at least from my understanding, is the explanation of interest and dividends, which is something that's, I think, extremely important when it comes to retirement, especially if you do it and do it right. Why? Because income, first of all, is something we need in retirement. Second of all, there's an easy way of getting it, then there's a hard way of getting it. If you invest for income, the easy way is just to take the income that's paid to you. That depends on how you're invested. The hard way means you're going to have to spend principal and hoping you recover it each and every year. Well, we all know that markets don't always recover. Some years, there's patterns of time when there's recessions, corrections, and there's other times when we have a robust bull market like we've seen in the last 12 to 18 months. But we always are kind of concerned. And when the markets are going up, typically eventually they come down or they start staying stagnant. And, if you want to win in any environment, good, bad, or ugly, then you want to invest for income. And so income is paid to you regardless of the markets. Well, the reason we have analysts because we want them to make sure that we have you in the right place economically, so that way your portfolio will continue to drive you income and reasonably be able to preserve your portfolio, because you're trying to preserve your portfolio. To do that, you got to be in the right instruments and be very selective. In other words, you don't want to go into retirement and driving blind and thinking it's just going to work out or stick our head in the sand. Yeah, and to do that, there are certain instruments out there that actually will pay you income in an income way and still be in the stock market. Imagine you got bond mutual funds and then you got bonds. Well, bonds pay more income than bond mutual funds, plus bonds, individual bonds, are contractually guaranteed both your principal will be returned to you and the income that they promise you, assuming there's no default risk. Bond mutual funds, you do not have those guarantees. So to people that are conservative or even moderately conservative, they want to have something that they can rely on and have less risk. That way they have peace of mind knowing the income's going to come in retirement. There is other people that want to be more aggressive. They want to have a potential of return of the growth module. And that's I'm talking about the growth component of total return equals I plus G, the G part. And then they also want to collect income. They're okay with a little bit more risk. So when it comes to risk and income in that perspective, there's risk in bonds, right? It depends on what type of bonds you have. No default risk. And when there's risk with stocks, means you can lose value, and you may not want to spend income out of that if you lose value because you don't know exactly what type of stock you have and does it pay income. So in other words, you want to own stocks that have potential growth, but at the same time gives you potential income. It's a lot better than the alternative, just selling principal in hopes to recover each and every year. In order to do that, I want to get a commission report in your hand called Investing for Income in the Stock Market, owning individual stocks. There's a lot of things you need to know when it comes to investing for income with especially stocks. You're already familiar with mutual funds and how that works, but unfortunately, a lot of income and more growth centric. Now we're talking about income first and growth second, which is in stocks. And this commission report can be yours if you call 888-930-1080. Again, that's 888-930-1080. And we'll mail this out to you if you're one of the first. If you, or mail this to you or email it to you, whichever you prefer. 888-930-1080. You're tuned in to the Retirement Income Source, and today we're talking about risk and income. You see, when you go into retirement, or you're still 5 years away, you want to be more eye focused. In other words, you want to make a change now instead of trying to continue to be on the path you're on, what we call total return focus. Well, total return focus focuses on growth first and income second. Eye focus, that is focusing on growth, focuses on income first and growth second. Well, the eye focus, income focus first is going to be able to hit your target, where if your growth focus, you may or may not hit your target. Because if the markets don't cooperate, then you're going to delay your retirement plans. You see, when you invest money, it depends on not just the amount of risk you're willing to take, but you're also wanting to get the reward if you take risks, and that's called investing. That's assuming you invest in stocks and you're just living on the dividend. But also people want to be able to have some growth where there's very little dividend in their portfolio. We run across people that can actually do both. And I'm all for having growth. The problem with growth is like the hare versus the tortoise. Growth jumps up very quickly, and then of course it loses very quickly. You can have a plus 40 and a negative 40 when it comes to more growthier stocks. But when you're in more of a balanced type approach where you have maybe a combination of both, a little bit more weightier in income dividends than you are on hardly any dividends, because a lot of your growth stocks today don't have any dividends. There's okay to have both, but you got to keep in mind you're going to have more volatility. The more growth you have, the more volatility you're going to have. Most people don't want that type of risk when they go into retirement. They want to have some of it, but they don't want a lot of it. And so it really just depends on the individual. I can go spend a whole show on just talking about investing for income in the stock market, being in the stock market, specifically owning stocks, and you can actually have consistent growth with individual stocks that pay dividends and equally perform over a 5 to 10 year period as it would be if you held growth stocks only. So think about it for a moment. I'd rather have the income more so focusing on growth than I would be growth without hardly any income. And not only that, you've got a problem to solve. You need income in retirement. And if you get growth, you're going to be okay. If you get loss, then you're not going to be okay. There's no way around it. I'm not going to paint a perfect picture and say that that's going to be a good plan. That's the reason why we focus on income while investing in individual stocks. Well, this is the end of our show, but I want to get a book in your hand called The Return of Your Principal, authored by CFA Dave Scranton. We talk about investing for income while being in the stock market, or if you want to reduce your risk, being more bond and bond-like instruments. You are listening to the Retirement Income Source. This is Tim Sparks. Thank you for listening.